ahead and get started. As I said, I'm Molly here from SoFi, and I am joined by our two guests today and moderators. We have Brian Walsh. He's the manager of our financial planning team at SoFi, and he is a certified financial planner. We are also joined today by Erika Kullberg, an attorney and personal finance expert. So without further ado, I'd love to hand things over to Brian. Thanks again to all of our SoFi members and guests for joining us today, and we hope you enjoy the webinar.
Awesome. Thank you so much for joining. Really excited, I think, for today's topic. I don't know if any of you have seen this before. I get excited about most finance topics. But this is a really interesting one because at SoFi, the team I lead, we meet with a lot of our members, kind of talk through personal finances and what's on their mind. And more student loans have been coming up. Maybe it's a combination of the interest rate environment, the suspension or pause on payments on federal loans, that ending in, 2 months now. So it's something that we wanted to kind of bring in, and that's why I'm glad we brought Erika in, really her expertise and kind of firsthand experience. Before we get started though, just want to throw out some compliance stuff. Nothing we talk about today is considered financial advice. So I'm a CFP, doesn't make a difference. Kind of look at this as education or guidance. Even if we answer a question, don't know enough about like your personal details, you want to talk to a financial planner, they can provide that advice to you. And we'll just kind of go from there. So Erika, I'd love for you to just kind of introduce yourself, brief background, and then we can kind of outline what we're going to talk about today.
Sure. Hi, everyone. My name is Erika Kullberg. I am a proud SoFi member. So I graduated from law school in 2016 with over $200,000 of student loans. I went down this rabbit hole of not really knowing what to do with my student loans. I felt overwhelmed. I didn't really understand how to lower the interest rate or any of this. So that's when I discovered SoFi. I ended up refinancing my student loans with SoFi, paid them off in 2 years, and then started a YouTube channel to talk all about personal finance.
That's awesome. And for everyone tuning in, we got some great questions during the registration process, but then as questions pop up, please feel free to toss them in the chat or the Q&A and we'll kind of get to them. But really today, what we're going to focus on talking through is on the student loan side of things. Yes, talking about refinancing, but then also there's a lot of other components that come into managing your student loans. A lot of the things that we tend to talk through on a regular basis would be, hey, let's understand the difference between your federal and your private student loans. That way you can really take advantage of each one of those for what they're worth. And then ultimately trying to think through like, hey, what's the best approach for me in handling my student loans? Is it going to be, minimizing what I pay right now, or is it going to be minimizing what I pay over the long term? And both are completely valid, just, different objectives. And then from there, figuring out, okay, what kind of strategies do we put in place to make either one of those happen? And yes, refinancing could be a part of that, doesn't have to be. So I think those are kind of the high level things that we'll talk through. I guess Eric could kind of kick it off. You mentioned, you had a bunch of student loan debt, paid it off super quick. I guess what led to that where you're like, hey, I want to get rid of my student loan debt to kind of trigger that process?
I just didn't like the feeling of them like weighing down on me. I think when I was in law school, taking out these student loans is very easy. Paying them off is very hard. I think when I was taking them off, it just felt like monopoly money. Like okay, everyone else is doing it. This is what I need to do to become a lawyer. I have to go to law school and take out a bunch of student loans. So when I was taking them out, I wasn't really thinking about them. And then after graduation, like graduation day, I also was not thinking about student loans. But then, if you have student loans, this like 6 months later, these letters start coming in the mail. They're like, you got to start paying it back. And that's when it really kind of hit me, the gravity of the situation I was in. So for me personally, I just wanted to get rid of them as quickly as I could so that I could have just more freedom in my life to decide what I wanted to do with my money. So for these 2 years, I was really working on following a strict budget, checking in every 2 weeks, making sure I was on track and just trying to get them paid off because I know you and I have taken very different approaches, but I just wanted that weight off my shoulders ultimately.
Awesome. And we'll get into it more later, but yeah, I guess for the audience purposes, I kind of took the polar opposite approach to student loans. And that's where I'm saying there's no right or wrong answer. I took the approach of, okay, I'm going to pay them back over a longer period of time because the interest rate is significantly lower than what I expect the long-term returns of the market to be historically. So both completely valid. We'll kind of talk through the pros and cons, but I guess, thinking about you tackling your student loans, like, did you keep the same strategy throughout, or was there some things you did early on versus kind of the middle and later on, or kind of how did everything get started with that?
I kept the same strategy throughout. So I think with any financial goal, or really any goal, my thing is create smaller goals that are more attainable. So I calculated how much I would have to pay each month in order to get these loans paid off in 2 years. So, you take the 2-year number, you divide it by 24 or whatever it is, whatever your mini goal is. So then I had a mini goal each month and just stuck with my budget to ensure that I could meet those payment requirements in order to meet the goal. So I didn't really change my strategy. Some months I had to adjust. So I remember like some months, I had unexpected medical expenses. So those months I couldn't pay as much towards my student loans. So then the month after, maybe I was cooking at home more and eating out less to be able to pay more. So, but generally for me, the strategy was the same. Come up with a budget, stick with the budget, adjust if necessary.
See, and that's what I find, super interesting, because it's like, okay, you identified what the goal is. You backed into, okay, here's how much essentially would need to be paid off extra each month in order to accomplish it. And then you kind of built your budget around that. So I think that's the ideal option, especially like when you're early in a career, a lot more flexibility to do that. I mean, what are your thoughts on the budgeting aspect for people who maybe, I don't know, let's say they're 5 years into their career where they have a pretty firm budget already? Would they still start in the same space? Would they start with their budget first? How do you think that would look if you started later on?
Yeah, I think wherever you are, it's all about assessing your current situation. So I find the easiest thing if you're about to start having a budget is taking a look at your past 30 days of expenses and really seeing where the money is going, after your net income. So the money that hits your bank account after taxes, how much of that is going to your rent or your mortgage? How much of that is going to food? How much of that is going to kind of eating out and shopping? How much of it is going to your student loans, and trying to figure out where you're at right now and then seeing where you want to adjust. Like if you see that a large portion of your budget each month is going towards shopping and you want to reach your financial goals, your other financial goals, like maybe paying off your student loans faster, maybe you reduce the shopping or the travel and increase the payouts of student loans. So it's really wherever you are, like if you've never budgeted, just take a look at the last 30 days, I think is the easiest, and figure out what percentage is being allocated to what and set goals. Like if 15% is going to travel and shopping and you want to reduce it to 10%, so that you can increase the payout to the student loans by 5%, you can do that. But ultimately, like the key thing with a budget is making sure it works with you. Because if I tell you like the ideal percentage, which doesn't exist, by the way, it's not going to work. Like you have to figure out what works for you, what is the nice balance between the quality of life you want, but then it's also like sustainable. So it's also sustainable enough to keep with it, but then also you want to make sure you're saving enough to put towards your financial goals. So yeah.
That makes sense. And I think it's another interesting piece is like the flexibility that you mentioned too, with the extra payments that you were making. Essentially, you had the months where, you said you had the unexpected medical expenses and you reduced it. So did you take the approach where it's like, hey, I'm going to, refinance and have, I don't know, call it, we're not going to name specific terms or rates, but it's going to be X, X number of years, and it'll give me a payment. And then I'll just make an extra payment on that to hit my 2 years. So that way I have flexibility. Was that the approach that you took?
Yeah, exactly. So if my, goal was $1,000 or $500 payment, and that month I couldn't do it, I only did 400, then the next month I would maybe try to do a $600 payment. So I had to be flexible because our lives, they're not always predictable. Like you cannot predict medical emergencies or your car breaking down. So you have to be just a bit flexible. But I think generally trying to find a baseline target that you're reaching for is helpful.
Yeah, that's awesome, because I think that's a conversation we have a lot when people are looking at either more aggressively paying down their existing loans, or especially when they refinance, they're like, okay, I want to refinance, but what term do I choose? Because like there's a bunch of different options and they have different interest rates. And I think it's about finding that right mix of, okay, the term that you choose, if you paid it off in that time, you're going to be like content, you're going to be happy. But it's not going to make you live on ramen noodles every single month. Although I kind of like ramen noodles. Um, and then you can have some flexibility there. So I think it's trying to find that balancing act for the term that you choose if you do decide to refinance, which is interesting.
Yeah, exactly. And everything is in finance, like everything is a risk assessment too. Like how much risk tolerance do you have? How secure does your job feel? Like for instance, my sister also refinanced her loans with SoFi, and her situation was a bit different because she thought maybe she would be going back to school. So she selected a much longer loan term than their payback term than I did. So it really depends on your risk tolerance and your situation and what you plan on doing for the next 2, 5, 10 years.
Gotcha. And you mentioned kind of the longer term process. I guess, how did you check in on things all the way and measure progress as you went and make adjustments?
I just had a budget tracker, and every 2 weeks I set a calendar invite for myself to meet with myself to just make sure I was on track. And honestly, I've never been that consistent with anything in my life. Like if I try a diet, it usually fails within 2 weeks. So I'm really proud of my consistency that like for 2 weeks, every 2 weeks for 2 years, I was just sticking with my budget. But I think once you start to see these little wins, like once you start to see your student loan balance go down and you're meeting your little mini goals, you get motivated. And that's again why I highly recommend not just having this one large overarching goal of paying off your student loans. Highly recommend breaking them down into these little milestones that you can celebrate, because it keeps you motivated. And that's ultimately what you need. Like it's not necessarily the easiest thing to just pay back your student loans and try to save money when your friends are going out, but having these little milestones and these goals to go after keeps you on track, I think.
Yeah, and that's probably been the biggest lesson that I've learned since I've been at SoFi for a little over 3 years now, is the importance of micro goals rather than like these big, like huge goals. Like, I think so many times, whether it be student loans or saving for retirement or emergency fund, like going from zero to accomplishing or even getting on track for any of those things is a huge effort. So that's where we start encouraging them, okay, let's break it down like 30, 60, 90 days. I mean, I think 90 would be the longest that we would tell people, like a quarter at a time. But typically we find that like 30 days ends up being a sweet spot for a lot of people, but everyone's different. Like, I don't know, I automate everything in my finances. Like I hate paying attention to my finances, so I can just put it on autopilot, but other people need to check in more frequently.
Yeah, I like automation too. So what I was doing, in case it provides helpful context for anyone, is I was doing auto pay for the minimum required payment. And then because I wanted to pay off faster, each month I would, looking at my budget and how I did, then I would make the additional payment manually on top of that. But auto pay, highly recommend that, because at least for the minimum payment, it's just nice to have that on autopilot. SoFi gives you, I think it was SoFi gives you a discount if you do auto pay. So of course I was looking for every discount. So I was like, yeah, auto pay. So.
Exactly. And I think, it kind of for context, because before we hop into some questions, we talked about, with your story, okay, let's, pick a target and really kind of minimize what we're paying over the life of the loan. Because, when you take a student loan and you pay it off quicker, there's going to be less interest growing on less interest, and it just will save you money on interest. Now, the flip side of that, and it's another approach we kind of mentioned briefly earlier, is like, okay, what if you want to minimize what you're paying right now, minimizing those payments? I think there's also some things that people could explore doing that, whether it be refinancing with more, extended terms. It could be income-driven repayment options if you have federal student loans. It could be different things like that we see people implement. And sometimes it's temporary, like, hey, I'm just getting on my feet. I need to get settled in for a couple of years and then I'll get after it. Other times it's more permanent, like it's just a strategic approach that, quite frankly, that's the approach that I took. So I think there are different approaches that you can take with this. And it really is starting with that question, figuring out what that goal is, and then you can kind of build a plan to achieve either side. Okay, so now we're going to hop over to the questions. If you do have any questions, feel free to toss them in the chat or the Q&A, and then we'll start rattling those off here in a minute. Okay, Erika, we'll start with a good one for you.
Okay.
What made you want to do this, aka get into finances? I'll let you go, and then I'll toss something there as well.
Okay, awesome. So after I paid off my student loans, I really wanted to figure out a way to kind of help people also pay off their student loans, because I remember how I felt when I was just so overwhelmed by it. I didn't see like a clear path to getting to this finish line for me. And I wanted to show people that it is possible. And so after I paid off my student loans, I left my job to start my own company. And at the same time, I decided that I was going to start this YouTube channel to talk all about finances. So that was really my motivation, is I wanted to show others it was possible. Learning about finances and paying off my student loans and just getting in tune with a budget and all of these financial things and learning how to invest, they really changed the trajectory of my life. It made me feel more in control of my money, more in control of my future. And so I wanted to, even though I didn't consider myself an expert when I started on YouTube, I was just some lawyer with a YouTube channel. Like, I wanted to try to learn as much as I could and share my own personal experience and hopefully educate others and encourage others that they can do it too.
That's awesome. And I think for me, honestly, I didn't grow up with money. So I made some fairly, I don't know, we'll call them suboptimal decisions right when I graduated college. Even though I had a finance background, like I knew the basics, and it took like a year or two of like just pain and sacrifice to get out of it and get in a good position. And then after that, I thought it was super interesting. And it's kind of the only thing I've ever done since then. So I enjoy it.
Once you get sucked in, it's hard to leave. It's so fun. Money is an everyday thing, but people don't really talk about it. So it's fun that you and I, like, professionally now, just talk about money all day.
That's true. Until like the end of the day, I'm like, oh, I need to talk about money for my own finances. I really don't want to. Oh, okay. So next question. Let me grab this one. The question is, can you talk about loan consolidation? I was really, really hoping someone was going to ask this question. If not, I was going to probably plant one and make it up, but I promise this wasn't made up. So this goes back to the whole idea of two different types of student loans at a high level, federal student loans and private student loans. So federal student loans from the government, they come with federal benefits, forbearance, income-driven repayment, public service loan forgiveness. Private student loans come from private lenders, like SoFi, for example. And they don't come with federal benefits. There could be some benefits, but quite frankly, most students need to take them to fund their education. And sometimes they can come with more competitive interest rates. So the reason I bring this up is because loan consolidation is for federal loans. It is a federal program in which you can consolidate multiple federal student loans into kind of one. So you could take like 8 payments into one. You keep your federal benefits, and you have the one payment. Your interest rate doesn't change, just a blended rate. That is fundamentally different than refinancing. Refinancing, similar concept on the front, where you take a bunch of loans and you move them into one, but it's a brand new loan with a private lender. So you're going to lose federal benefits. But on the flip side, depending on your underwriting profile, things like that, you could reduce your interest rate. So two completely different concepts that I just want to make sure people really appreciate, because the last thing I would ever want to see as a financial planner is someone thinks they're consolidating, but they refinanced, or vice versa. So awesome question. Erika, I promise I didn't plant that. It was actually in.
No, I know.
Okay.
I trust you. It was a good answer.
Okay, so next one we're going to toss your way. What are some good ways, or how could I lower the interest rate on a student loan?
Yeah, I like that one. So this is obviously the one I personally chose, is to refinance. That's one way to potentially lower the interest rate. Another one is an option like an auto pay discount. Some companies that you potentially refinance with will offer you an auto pay discount. So maybe, point something % just for subscribing or signing up for auto pay, which means that it'll automatically deduct from your bank account the monthly, whatever you set monthly. Another one, some companies, I know SoFi has this, some kind of loyalty discount. If you have multiple products with them, then you could possibly get a loyalty discount. So those are a few concrete ways to potentially lower the interest rate. I don't know if you have anything else to add to that, Brian.
Yeah, I think a couple things come to mind. I think number one, if you're going down the refinancing route, I would say check out the rate match. So with SoFi, and other places have it too as well, but I know SoFi firsthand. So if you have a lower rate, then match it and give you $100 once the loan's funded. There's terms and stuff like that, and all the disclosures I'm supposed to say. I'm probably missing some details, but I think making sure you do that. The other thing too is we come across situations where maybe people might not be able to refinance their student loans and they still want to save on interest. So some possibilities there could be like, okay, hey, maybe I want to save money on interest by making some extra payments, because it's not going to lower your interest rate, but it could be helpful. And the other thing too would be, potentially your borrowing profile may change as you make more money, you become more established in your career, your credit score changes, other things like that. So that's why I say it's always worth exploring things on a regular basis. All right. What do we got going on for the next question? If you see any in here, you feel free to toss them out my way. Otherwise, I'll keep going. Can I choose which loans I'd like to refinance? Is fixed. Oh, so we'll break this. I think this is a three-parter. So let's start with the first part. Can I choose which loans I'd want to refinance?
I'll let you handle that one. I'll handle part two.
Okay. Yeah, you can mix and match, different loans. So like a perfect example of that, I remember, gosh, it must be like 4 years ago now, I refinanced with SoFi for the first time. Like I went in there and I had a bunch of student loans, because I think I had like 2 or 3 for every semester. I don't know. It was like, the list was like this long. And like I was just checking and said, okay, here's the ones I want to refinance. Here's one I didn't want to refinance because the interest rate was lower than what my rate was going to be, and stuff like that. So yeah, you can mix and match, and you can pick and choose. Next question. Ooh, this is a good one. I'm excited for your answer on this. Fixed rate or variable rate? Which one's better?
Okay. I like this question because I get asked it all the time. So the short answer is neither one is better. It just depends again on your situation. And I realize I sound like a broken record just saying like your situation, but it's true. So a fixed versus variable rate. A fixed rate is you're going to get one interest rate for the entire term of your loan. A variable rate means that based on whatever it's tied to, market conditions, it may fluctuate month over month or every few months. So variable rates tend to start lower than fixed rates, but they could. So if a fixed rate is like this, it stays the same the entire time. A variable rate could kind of look like this or like this, or like, like this. So again, comes back to risk tolerance. Like, would you prefer to start with perhaps a higher rate, but it's fixed, meaning you can predict each month how much is due because it's a fixed rate. For the term of your loan, it's going to be the same interest rate. Or are you a little riskier and you want to maybe start off with a lower, perhaps lower interest rate that's a variable rate, but then you're okay with the risk that maybe it could creep up eventually, or maybe it stays lower. And so one of the things you want to look at is, what is your payback time frame? How quickly do you want to pay it back? Because that's something that you have to account for in this risk factors, right? So for me, for instance, I was looking to pay back my student loans very aggressively. So I took a look at, how much I had in my emergency fund, how secure my job was, the fact that I wanted to pay them off in 2 years. And so I made a decision to do a variable interest rate based on those factors. But if you have maybe a longer payout time frame, or maybe your job isn't as secure, so you kind of want to stick with the fixed, which is lower risk, then that's something to consider too. I don't know if you have any thoughts to add to that, but that's basically how I see fixed versus variable. Is it's a risk factor assessment, and just again seeing what works for you.
Yeah, no, you're exact. We always talk about risk and time horizon, and those two things are exactly what you said. So nothing to add.
Yay.
All right. This one should be a short. Can I pay more on my refinanced loan than what the required minimum payment is?
Yes.
Which is what you did.
Yeah, easy. Pay the minimum, and then if you want to pay more, if you have more in your budget, then you pay extra, and you can pay them multiple times too. Like sometimes I would add $100 extra payment.
Okay, next one coming in live. With the projection of higher income in the future, isn't it better to not be aggressive on the repayment and stretch it out further into the future? Similarly, isn't it better to use extra cash to contribute into a 401k rather than pay off early the student loan? Yeah, I guess I'll toss this one. Number one, yeah, the whole inflation side of things and how that's going to impact the overall economy. That's TBD. I don't think anyone's in the business of kind of predicting that, but honestly, I think what you're saying here with the relatively low interest rates of student loan debt compared to other uses of money is very, very compelling. And I think something people need to consider. So when you look at it, just straight up math, and you take human behavior out of it, if you invest money, the long-term historical rate of return of the S&P 500 has been 7% when adjusted for inflation. A lot of student loans are below that. At the same time, there's risk associated with investing, and there's emotional baggage associated with student loan debt. So based on the math, I chose to go the math route. I'm like, hey, I'm going to invest instead of making excess payments. A lot of other people, and Erika's a perfect example of that, is hey, the emotional benefits and those other benefits associated with paying off the student loans faster, even though according to the math, it makes their finances better. So I think either approach can be justified. It's just understanding why you made that decision. Anything to add, Erika?
No, that's a perfect answer. It's all, there's going to be a perhaps mathematically optimal way to do things, but those mathematically optimal ways don't factor in human emotion. And obviously I went with more of my emotions. I remember having this exact conversation with people. They were like, well, you're paying off your student loans so aggressively, but if you just put that money in the market, you'd probably make more money. But that's perhaps true based on history, but history never accounts for the future. You can't, hindsight is 20/20. That's one thing. And I think the mathematically optimal way just didn't factor in my emotions. And I just wanted that baggage out of my life. So I went in hindsight, I went the non-mathematically optimal way, because obviously hindsight told me that if I had put that money into the market instead, I would have done better. But, as you saw in March 2020, market corrections happen. Like you can never predict the market. You can never predict any of these things in the future. So I went with the choice that I felt comfortable with, because now like 100% certain my student loan balance is 0. And to me, that was so much more worth it than trying to get a few extra percentage points in the market.
Yep, for sure. And I think the one thing I guess I'll throw out, where I'm not saying they're like non-negotiables, but they're pretty darn close in my mind, are like, if you don't have an emergency fund, or if you have like high interest bad debt, like credit card debt, where you don't have the appropriate insurance in place, like please, please, please do those things before aggressively paying off, good debt like student loans. If I didn't say that, then the financial planners watching this, we're going to be like, Brian, you forgot about this stuff. Okay.
An emergency fund is your lifesaver. Like that is the very first priority for you, because we cannot predict what's going to happen. We cannot predict when I might get laid off. Like we cannot predict any of these things. We cannot predict car emergencies, whatever it is. Having that emergency fund, it's a buffer. What it does is, if those worst case scenarios play out, instead of having to take out potentially high interest debt, credit cards on average charge 15% interest rates. Like instead of doing that, you have this emergency fund to fall back on, and it's going to help you with your finances, because otherwise, a lot of times it seems like these emergencies cause this downward spiral because people aren't prepared for them. They have to take out debt. It's incredibly hard to pay off credit card debt because the interest rate's so high. And so it causes a spiral. So it's just basics to protect yourself. You need that emergency fund. You need to tackle this one. You have to go for the mathematically optimal route, I think, which is if you have student loan interest rate at this percentage and credit card debt at this percentage, you have to go after this. Like this is one where I say that you have to go for the mathematically optimal route. Don't go for your emotions on this one.
Exactly. And on the emotion side of things, the funny thing is an emergency fund, like that's the single biggest determinant of financial stress and financial anxiety. Like if people don't have a cash cushion, they are going to be much more stressed and anxious about their money, which then bleeds over to their life. So I mean, I think that's the other thing that we throw out there too. Yeah. Okay, next question. I'll handle this one real quick. How does SoFi determine student loan refi interest rates? Yeah, so I mean, like at a high level, they'll look at the basic information as far as income, your credit profile, a bunch of other factors to determine whether or not you'd be eligible for a student loan refinance. If so, what the terms would be. I think the cool thing about SoFi to me is you can check your rate and check if you're eligible using a soft credit pull. So like if you're in doubt, you're like, hey, could I get a lower rate or whatever it may be? Like check your rate. It doesn't ding your credit score to do that. So I think that's something that's worth checking out if you're on the fence. All right. Next question. Ooh, I'm going to take this one. I'd love to get your thoughts on this too, if you want, but this one gets asked a ton, gosh, 2 years now, but then especially recently. Do you think public loan forgiveness was actually going to work out? Short answer is I have no clue. And at the end of the day, like, yes, student loans are a major aspect of SoFi. So I'd like to think we're fairly tuned into things, and I try to follow things as much as I can. So we don't necessarily know what's going to happen. When it comes to a financial planning side of things, I think it's important to make decisions based on the facts on the ground. And at the same time, you consider things that could happen, but it's kind of tough. So that being said, the federal suspension of student loan payments is something that we have known about, and it has been reality. So I think, taking, advantage of that has been something that we've encouraged people to do from a planning perspective. Cool thing that SoFi is doing now is the Snooze program. So you could lock in the rate today. And, in the interest rate environment we're in, and it's, wouldn't actually make payments until October. But then on the loan forgiveness side of things, I think not only is it important to understand that like major actions and policies like this take a lot of cooperation, but then also, what types of loans they'd apply to. At the end of the day, federal and private student loans are different. And, in theory, could this happen to federal? Maybe. Private, that's completely different. So I think I would look at what types of student loans I had too, as I'm making this decision, and how I, value the federal benefits as well, if I have existing federal loans.
Yeah. And one thing I would add to that is, if you have not done this yet, one of the first steps I think everyone should take is create a list of all of the student loans you have, and who they're serviced by, whether they're federal or public, how much outstanding, and the interest rate. I think it's really important to see everything in one sheet, Excel sheet, or on a pen and paper, whatever it is, just see it, because that'll really help you to make these decisions about, okay, if I have these federal loans and these private loans, maybe the private loans, I'm going to do something differently with them than the federal loans. And so if you have not done that, that's one of the first things I recommend you do. I had not done that until like 6 months after graduation. Like, honestly, for the first few months after graduation, I didn't know my situation. It turns out that I had like 3 different servicers, 6 different interest rates. It was a whole mess, but getting that all on paper and seeing it all there helped me to start making decisions about what I wanted to do with my student loans. So if you haven't done that, really recommend.
Yep, that's a good point. All right, next one, another live one. How about parents taking out money from their retirement to pay for their kids' student loans? You got any thoughts on that? I have thoughts on it, but any thoughts on your end?
I don't. I'm curious to hear your answer.
So, like, this question is, for me, like, this is like a tug of war, because I have 2 kids, and as like a parent, I'm like, oh man, like, we try to do everything we can for the kids. As a financial planner, I'm like, no, do not do this. So I think at the end of the day, it's important to remember that there's no student loan equivalent for your own retirement. So if you deplete your retirement resources, or if you don't save enough money to either pay for your kids' college or paying back their student loans or whatever it may be, then you're either reducing your standard of living and living on less, you're working longer if you can, or worst case scenario, like, you become a financial burden on your kids, which you were trying to help to begin with. So if you're going to consider doing that, I think run a retirement analysis and see, like, hey, am I on track to retire? If you are, cool. Now let's add in, what if I spent this much of my kids' college, or if I paid off this much of my kids' loans? See if you're on track. If you are, cool. I think you have some flexibility to decide if you want to do that. If not, then I think it's okay. Am I willing to make those trade-offs? So I think it has to be a really deliberate decision and not put your retirement in jeopardy. Okay. Next question. I'll take another live one. How does SoFi make money on refinancing? If I have a loan with SoFi already and refinance it to a lower rate, what's the downside to me? Where are the hidden costs and fees? Yeah, so I guess I'll kind of break this question apart a little bit. So I guess the part related to, you have a SoFi student loan and you're like, hey, can I refi that with SoFi? Like, generally speaking, like, yeah, I mean, you'd have to apply for it and everything, and you'd have to be approved, and you'd see what the rate and the terms were and everything. But yes, and quite frankly, that's something I actually did. I refied am I allowed to say that? So anyways, so that's something that you can potentially do. SoFi doesn't have fees related to student loan refinancing. And ultimately, how we make money is through essentially taking all the money that we lend and selling things as asset-backed securities on the financial markets. Perfect. Eric was laughing at me like I'm gonna get in trouble for that answer.
Yeah. But I did it too. That's what I did secretly. If you are going to get in trouble, I'll get in trouble too.
No, and I think that's where earlier I mentioned, like, hey, checking your rate. I think that, like, when it comes to private student loans, and like, once you refinance, I mean, we encourage members that we talk to, like, hey, if you got an income increase, or your credit score improved, or maybe your debt profile improved, like, okay, it's worth checking. Like, there's no harm in checking to kind of see what your situation would be like, especially if you're not going to pay fees or any sort of costs like that to do the refi.
Yeah, exactly. And just like Brian said, basically, I was getting a little pay increase every single year. So every single year I was checking if I was eligible for a lower interest rate to refinance.
Awesome. So I think we are going to wrap up because we're at time. I guess a couple, quick follow-ups before we close down. Number one, we kind of briefly mentioned a couple of these things, throughout the conversation. The rate match with SoFi. So if you're kind of going through the process and you have a better rate, SoFi will match it, and $100 when the loan's funded. So there's terms and everything to that, but I think it's worth checking out. And then the Snooze program too. I think that's really, really cool. Like when I found out that we were, doing that, I was like, oh, that's legit. Because from a financial planner, that's always been a challenging aspect with the federal loan payment suspension. So you can, ideally, try to lock in, low rates today, and you don't make payments until October. So you can kind of go through that process and explore that if you have any questions. But other than that, any closing thoughts before we head out?
For me, I would just encourage you to take a look at your student loan situation, map it out, do the columns that we talked about, and start setting those mini goals. I think if you focus on the mini goals, it becomes a lot less overwhelming and you'll get closer and closer to your goals, that your ultimate large goal that way. So I would just encourage you to not let this fear of whatever student loans you have hanging over you stop you from actually just sitting down, taking 30 minutes today or tomorrow to map out your situation and what your goals are and how you're going to meet those goals, and get a budget.
And then I guess from my perspective, a lot of times like this can be intimidating, and there's tons of questions that come up. Don't feel like you have to go it alone. Like, yeah, leverage resources like this, or go on the SoFi app and see the upcoming, live streams and webinars and stuff like that. Like, awesome. Or honestly, the team I lead, like, schedule a complimentary call. Our planners are here to help kind of weigh the pros and cons of student loan decisions, whatever it may be. So feel free to check that out in the app or on SoFi.com. Otherwise, thank you so much, Erika, for joining. And thank you everyone for tuning in.
And also, I have one pitch. If you go to youtube.com/SoFi, I have a few videos that I've made with SoFi on student loans and everything. So if you want more of that, you can go to youtube.com/SoFi.
Awesome. I'm checking it out tonight instead of watching my kids' random Blippi videos.
Awesome.
All right. Have a good night.
Bye, everyone.